and welcome to TS's Finance Nuggets. In today's video, we'll be analyzing the risks associated with investing in stocks. A lot of us might have an idea of what risk is, but I think a definition that perfectly captures the context of investing in stocks is the Chinese symbol. It is basically danger and opportunities coined together. For us to get returns, we have to take risks, and as such, we should find a perfect balance between danger and opportunities. We have price risk. The price of different stocks go up and down for different reasons. And one question people ask is, can I lose all my money? Well, as a general rule, the only way you lose money when you buy anything is when you sell it for a price lower than the amount you bought it for. And with stocks, we should actually give our stocks time to appreciate. For example, real estate, you don't buy a house and then after 2 months, you're already thinking about selling it. This rule should also apply to stocks. Let's assume you bought a share in Tesla in July 2023 when it was priced at $203 and in November you panicked and sold it for $193. Well, you'd have lost a lot of money. But if you had waited till today, 11th of January 2024, it's currently priced at $224. Still lower than the amount you got it for, but it's lower than the amount you sold it for out of panic. Another question that you might be thinking is, can the stock price actually go to zero? Well, if you invest in an individual company and the company actually goes bankrupt or goes bust, yes, all your money is gone. But you might get a portion of your money back if the assets of this company is diluted. However, there's an hierarchy to how this is distributed. First in line are secured creditors, and then unsecured claims by banks, and after all secured and unsecured claims have been made, then we have the stockholders. However, if you invest in an index fund or a diversified portfolio, for example, an index that replicates the performance of the S&P 500, your money would never go to zero. Before the stock price of all the major companies in the world like Amazon, Google, Tesla, Meta actually goes to zero, then something really drastic must have happened that affected the whole world. During the COVID-19 pandemic, which was a really uncertain period for the whole world, the S&P 500 went from a peak of $3,337 to $2,304 by 20th of March. This was a drastic change, but no, the market didn't crash to zero. Now that I've answered the two major questions, what are the other reasons that can have negative impact on the share price? First is economic downturn. Unfavorable economic downturn will affect a company and in turn the share price. Another risk is company-specific risk. If a company has poor performance or poor management, it will also affect the share price of that company. Another risk is industry risk. If a particular sector has been unfavorably affected by economic downturns, it will affect the share price of any company in that sector. There are different models to actually measure risk, but one widely used theory-based model is capital asset pricing model. Thank you for watching, and if you found this video useful, don't forget to give it a thumbs up and subscribe down below at TS's Finance Nuggets.